Good morning, everyone. This is Group 2, and today we are going to present about how should central banks respond to stagflation. Now let's move on to the table of contents. There are six main parts of our presentation today, and the first one is the introduction. Then we will discuss about the macroeconomic overview of the US. Then is the cause of stagflation in the US, central bank responses, and policy tools. After that, we will discuss about the policy dilemma and theoretical evaluation. Then we will talk about the recommendations for the central bank of the US. And last but not least is the conclusion. So my name is Yun Jane, and let me introduce about the topic a little bit. In 2022, inflation in the US economy rose above 8% for the first time in 40 years, raising serious concerns about macroeconomic stability. This situation signals the possible return of stagflation, where high inflation happens alongside weak growth and labor market pressures. Against this backdrop, a key question emerged: how should central bank respond to stagflation without either crushing growth or letting inflation getting out of control? So in this presentation, we will use the US experience as a case study to explore the policy options and trade-off central banks face.
Over the last decade, United States GDP was quite stable before COVID-19, growing around 1 to 4% per quarter. In 2020, the economy collapsed by nearly minus 30% in quarter 2 during the nationwide lockdowns, but this reported strongly with a plus 35% in the quarter 3. Since 2021, growth have returned to the small gains, usually 0 to 3%. In nearly 2025, GDP grew only about half a percent. This quick and slow recovery raise concern about the positive stand stable. From 2015 to 2020, inflation stayed low, hitting 1.4% during the pandemic. But in 2021 and 2022, inflation surged to the 7% and 6.5%. This is the highest in the decade. This have cooled to around 3% recently, but still above the inflation reserve 2% target. With inflation still evaluation and rose slowly, stagflation rate and demand notable. After the COVID-19, unemployment fell safely from about 6% in 2021 to about 12.5% in 2022, showing this is a strong labor market. However, since 2023, this has started to rise again, reaching around 4.4% in 2025, with the higher unemployment happens together with a slow growth and high inflation. This is a sign of growth concern about the stagflation in the United States economy.
Hi, my name is Phương. In this session, I will explain the key factors that contributed to stagflation risks in the United States. Stagflation happens when three conditions occur at the same time: high inflation, rising unemployment, and slow or negative real GDP growth. In the US, this combination emerged from global supply shocks, expansionary monetary policy, and rising corporate pricing power. The first major driver was global supply shocks. After COVID-19, worldwide supply chains were heavily disrupted. Shipping delays, factory shutdowns, and shortages of key inputs made production more expensive. The Russia-Ukraine conflict made this worse by tightening supplies of oil, gas, wheat, and raw materials. These disruptions pushed production costs up, leading firms to cut output. Economically, this caused a lateral shift in the short-run AS curve, meaning less output and higher prices. For the US, this created sharp increases in energy, food, and commodity prices. As shown in the chart, many commodities spiked dramatically during 2021-2022. These rising input costs Fed directly into nationwide inflation and slow growth, setting the stage for stagflation. The second factor was expansionary monetary policy. During both the historical 1970s and the recent recovery period, the Federal Reserve kept interest rates low and allowed money supply to grow quickly. This boosted AD at a time when the economy was already close to full capacity. Demand was rising, but supply was still constrained by global shocks. As a result, inflation accelerated while output couldn't keep up. This mismatch, AD rising while short-run AS shifts left, creates the exact conditions that lead to stagflation, high inflation paired with weak real growth. The third contributor was rising corporate pricing power. Research from 2022 to 2024 shows that high corporate profits played a meaningful role in sustaining inflation. Many firms raised prices beyond their cost increases and kept the prices high even when input costs later declined. These sticky prices meant inflation remained elevated even as the economy began to slow. Persistent price increases combined with weaker output growth strengthened the stagflation effect.
Hi, my name is Oti, and now we'll explain how the Federal Reserve System has used the monetary policy tools to address stagflation pressures in the US. The Fed relies on three main strategies: policy interest rate, quantitative tightening, and forward guidance. The first tool is policy interest rate. This is simply the target range for the federal fund rate, basically the rate that influences all borrowing costs in the economy. So when the Fed raises rate, borrowing becomes more expensive. So people spend and invest less, which cool down demand. Since March 2022, the Fed raised its rate from almost 0 to 5.25% to 5.50%. So that's a huge jump, and it's played a major role in pulling inflation down from 9.1% in mid 2022 to 2.9% in 2024. The downside, of course, is that higher rates slow economic activity and put pressure on sectors like housing. So the Fed constantly has to balance this inflation with the risk of slowing growth too much. The second tool is quantitative tightening. This means that the Fed reduced its holding of treasury and mortgage-backed securities. So by shrinking its balance sheet, the Fed removes liquidity from financial markets and pushes long-term interest rate higher. So the balance sheet went from $8.9 trillion in 2022 down to about $7.2 trillion in 2024. The quantitative tightening reinforced the impact of interest rate hikes, but it still mainly works on the demand side. It doesn't fix supply side problems like energy stocks or global shipping delays, so which are major contributors to stagflation. The final tool is forward guidance, basically how the Fed communicate what it plans to do next in the future. This matters because people's expectations about future inflation actually influence their weight in price decisions today. So throughout 2023 and 2024, the Fed repeatedly emphasized its commitment to bring inflation back to 2%. And this method worked. 3-year ahead inflation expectations fell to 2.3%, the lowest since the survey began in 2013. And that drop shows that the household trusts the Fed's action, and then core expectations have prevented inflation from becoming self-reinforcement. Overall, the Fed's tools have clearly helped bring inflation down, but it can't fully solve supply-side issues. So that's why monetary policy needs to be supported by fiscal and structural measures for a more durable recovery. Moving on, policy dilemma and theoretical evaluation part. When we look at the recent data, it's clear that the Federal Reserve is facing a real policy dilemma. The Fed is still tightening monetary policy to bring inflation down, but the labor market is starting to feel the pressure. According to the Bureau of Labor Statistics, unemployment has risen to 7.2 million people, which is about 450,000 more than a year ago. So the unemployment rate has also gone up from 3.7% to 4.2%, showing that higher interest rate or slowing overall economic activity. We see the same trend in important measures of job market weakness. The youth rate would include unemployment workers plus people stuck in part-time jobs or marginally attached to the workforce, increased from 7.4 to 7.8. So this tells us that it's becoming harder for people to find a job they want, especially as businesses pull back on hiring in a high-rate environment. All of this highlights the core dilemma. The Fed has been successful in reducing inflation, but those same policies are putting more strain on workers. So the challenge is that one tool can't solve both problems at the same time. Raising interest rates cools inflation but also cools the job market. So lowering rates would hit employment, but it risks pushing inflation back up. This trade-off is exactly what makes stagflation so difficult to manage.
Moving on to the next part, traditionally the Phillips curve shows an inverse relationship between inflation and unemployment. When one goes up, the other typically goes down, but in recent decades, this relationship has weakened. Global shocks, supply disruptions, geopolitical tensions, and energy volatility have all flattened the curve. This means inflation and unemployment no longer move predictably in opposite directions, making policy-making much more challenging. One key positive outcome is the sharp reduction in inflation. The CPI peaked at 9.1% in June 2022, but dropped to below 3% by late 2024. This improvement came from the Federal Reserve's aggressive rate hikes, raising interest rates to 5.25 to 5.5% between 2022 and 2023. These actions helped bring inflation back under control, even though they carry economic trade-offs. Here we see the first negative outcome, slowing economic growth across 2023 to 2024. GDP hovered near zero for several quarters. At the same time, business investment weakened, largely because higher borrowing costs discouraged firms from expanding. The second negative outcome is stress in the labor market. Unemployment increased from 3.5% in 2022 to around 4.4% by late 2025, signaling softer hiring and reduced confidence across industries. Finally, supply-side challenges remain unresolved. Energy volatility, supply chain disruptions, and labor shortages continue to weigh on production. Even with lower inflation, households still feel significant cost of living pressures.
So we'll move to the next section, which is recommendation for the Central Bank of United States. The background of it could be post-COVID inflation surge due to global energy and food price shock. Inflation peaked at 8.6% in May 2022, highest percent since 1980s. Fed raised the rate from 0% to 5.25 and 5.5%, the highest figure for 23 years away. Inflation remained persistent, monetary tighten along efficiency, so the main goal is to lower the inflation rate. And after that is some recommendation to solve this problem. First, in measure monetary policy, maintain higher for longer interest rate, adjust money supply carefully, shape policy gradually when inflation pressures ease. Two is communication and transparent. Use clear communication to guide expectation, publish monthly, quarterly, yearly forecast uh, for CPI, average income, 1 to 5 years inflation expectation, energy cost, and credit condition. After that, he prepare contingency plan for the worst case scenarios. And finally, coronary fiscal support provide financial relief for smart but business. Invest the workforce training and SME innovation. Expand access to affordable housing to reduce wage pressure. And finally, the summary, Fed needs a balanced strategy combine monetary policy, clear communication, supportive fiscal measure to bring inflation back to 2% without slowing recovery or lowering living standard.
Now, to conclude the presentation, policy must include smart interest rate adjustment, target government spending, and clear, transparent communication. Structural reforms, stronger supply chain, and improved workforce training are essential for long-term stability. So overall, fighting stagflation demands a coordinated mix of monetary, fiscal, and structural policy to restore stability and support sustainable long-run growth. This is the end of our presentation. Thank you for listening.